You are listening to ChartingWealth.com for Tuesday, the 29th of March, 2016. As we continue to see the month roll ahead and almost disappear, what do we have going on in the market? Well, market opened up on Monday after closing down on our two-day candle for the end of the week. And what do we see happen? Well, we pretty much had not even a spinning top. We had pretty much a doji. The market was technically up 0.5%, but it's really hard to tell with the type of candlestick, the Heikin Ashi that we are using, which is a great form of candlestick. If you don't know what it is, you do need to review our teaching on that. What do we have going on? Well, you can see, those of you who are listening, I will explain to you. We have the derivative oscillator losing a lot of its energy. It is down at the very bottom. It does appear that the MACD is closing in for a crossover on the two-day chart. It's not happened yet, but it may be happening in the near future. If we look at our intraday action, we can see, as far as the charts went, that the way the market closed on Friday, a little up during the end of the day, still a down day on Friday, but what ended up occurring over the course of Monday is that the market moved up a little in the morning and a little in the afternoon, and again leveled out at only up about 0.5%. Derivative oscillator lost a little bit of its speed, but really no change in the down movement on the short 4-hour chart. So still in a confirmed down move on the short chart, and like we were saying before, on the large chart, the total market is still in a confirmed up move. So we'll continue to see if that down movement on the short chart is going to be enough to drag the total market over, just slipping sideways at this point. So we don't have any moves to date. We have a little bit of schizophrenia going up on the big chart, down on the small chart. We're going to see if that down tug is enough to pull the big wave that is the two-day chart over. Hasn't happened yet. Okay, let's go back now. We're on the two-day chart. We're going to look at the S&P 500. It looks somewhat similar. Again, sort of a sideways slide. It was up a little bit more than the total market. It was up 0.07%. We can see derivative oscillator losing energy, and it does appear that the signal line is approaching the MACD, the moving average convergence divergence line on the big chart. Hasn't yet crossed over, and again, the two-day candle that started on the 28th will wrap up at the close of the market on Tuesday, the 29th. Now, if we look at intraday activity, it's going to look a little bit similar, although a little bit more of an up movement throughout the course of the day than happened in the total market. The S&P 500 was up a little more, up in the morning and then up again in the afternoon. More up movement actually than the market settled out, but again, slipping sideways more than anything else, still in a confirmed down move on the short chart. Up move still confirmed on the big chart. So we'll continue to watch. We don't have any definitive answers at this point. We are below the two-day trend line. That, of course, has been broken. Now, we're going to move back out to our two-day chart, and we're going to look at the Qs. What is the Qs? Well, that is the NASDAQ 100, the tech stocks. Technically, it was down 0.14% for the day. The derivative oscillator has lost a lot of its energy, and on the two-day chart, it looks as if the signal line and the MACD are getting closer, up at the very top of the range. And again, for the last, I would say, a day and a half, we've actually seen the market slipping sideways. It's not gone above where it was on all the way back to Monday, the 21st of last week. The market has not reached a higher high than that. So really just sliding sideways. Again, not a crossover going down yet on the two-day market. Let's look intraday on the NASDAQ 100 as represented by QQQ. What do we see going on? We see some up movement in the morning and then a doji in the afternoon, breaking through the two-day trend line, crossed over, of course, going down back on the 23rd on the short chart. So that is where we are with our three main indexes. We're waiting to see what settles out. If we do see now on these short charts a rollover and the market starts moving back up, what does that tell you? Well, that's a signal that you want to get in and go with the prevailing attitude of the big chart, right? We always look to ride the big wave because the big wave is where the big money is. The short wave, we watch to oscillate back and forth, and when the short wave, that is the 4-hour chart, is going the opposite direction of the big chart, we see if indeed it's big enough to pull the big chart down. If it's not and it rolls back in the direction of the big chart, that's when you use the small chart to jump in with your virtual trade and ride the movement of the big chart up. It's like jumping on a big wave. So that's what we always want to find, a good jumping in point, because you don't want to jump on the big wave when it tops out. You want to jump on the big wave when it's going back up again. Does that make sense? Again, think of it as a wave theory, if you will. Now, let's go to gold and see what's up with that. Gold was up 0.25% for the day on Monday. What do we actually see going on? Well, gold crossed over going down on the 15th of March and steadily moved down. It was an up candle forming, and again, it's just the first day of a 2-day candle on Monday. That candle will conclude on Tuesday when the market closes. But what we see happening now is derivative oscillator has heated up. MACD, of course, is in a down momentum, and the signal line and the blue MACD line are moving further apart. They are diverging as opposed to converging. So the market has continued in its down movement, even though it was an up day of 0.25%. We still are being told by our indicators that the market is moving down. So let's look intraday and see what's happening with gold. Intraday, gold has really just sort of hit a level. It's really not gone below the low that it hit on the 23rd of March on Wednesday morning. It pretty much bottomed out, and it's just been sliding sideways since then. It's not gone below that. Derivative oscillator is actually losing some energy. So again, we'll just continue to watch. We don't have any sign telling us to get in. Maybe it'll correct and start moving up on the short chart and then roll back over to parallel the down movement in the big chart. If it does, that could be an entry point on the short chart to get you into the long down move. Or if that doesn't happen and it continues to move down, if you weren't already in a down move, then you would wait for it to correct and then look for a getting in point. Again, we don't try to get in ahead. We want to see the market correct, move in a certain direction, wait for a rollback on the short chart, and then jump in and ride the wave that's already established if it continues to move in that direction. It doesn't always. We can't control the market. We can only control the entry points that we get in, and we want to time that entry as best we can so that we minimize our risk of loss and maximize our hopes to gain while doing both of those at the same time. We don't want to take all the risk and then get all the reward. We're willing to give up some of the reward to reduce that risk. Does that make sense? And how are you going to learn this? You're only going to learn it by opening a virtual trading account at MD Online Brokers and then listening to us day after day, practicing with the charts, entering into these practice trades and see if they work. And if they don't work, go back to the drawing board, figure out what's going on, listen to more of our training, read more, study more, work harder, deal with the charts, understand how they work, and it will come to you. But you know what? Wisdom does not give up its prize easily. It takes work and dedication. That's what it takes. And let me tell you, you don't have to have a PhD. You don't have to have an MBA. You don't have to have a law degree. You don't have to have worked on Wall Street. You have to be willing to put in the time and the energy and the common sense to figure it out. That's what we're all about here. We're not a stock calling service. We are a teaching education company. That's what we're all about, and we love to hear from you. Follow us on Facebook, Twitter, Instagram, YouTube, you name it. We are there. We are chartingwealth.com. We'd like you to go sign up for our newsletter. If you really like what we're doing, go to iTunes, subscribe to Charting Wealth, give us a 5-star rating and a great review. We would so appreciate it. Thank you so much from chartingwealth.com.